and a very warm welcome to everyone on the line, both existing clients, but also for those listening to us for the first time. I just want to introduce the team. The four of us, Katrina, Espen, Desmond, and myself, are still working together as we have done for the last 2 years. And it's been almost a year since we started doing these webcasts, and I spent a little bit of time ahead of this just looking back at some of the previous versions, and it's easy to forget how much can change in the year that has gone by and where we've been working more remotely than perhaps we would have liked. But also some things never change in our industry. So investing is a noisy game. This Economist cartoon from 1997 shows that that's nothing new. As many of you will know, sentiment can shift fast, often violently, but almost always unpredictably. And when we started last year's meetings back in January, we had relatively a calm market, and we did face-to-face meetings with some of you. And the outlook was relatively optimistic. You can see that from the Bank of America sentiment indicator, which shows that most people were relatively optimistic as we headed into 2020. By the time we were doing our spring updates, both the markets and sentiment was in free fall, and many of you and ourselves indeed were about to enter lockdown. And you could see that both in the fund's NAV, but also in the extreme movement in sentiment that hit sort of crisis levels. By the time we did our June updates, we had moved off the crisis bottom in terms of share prices and NAV, but sentiment was still very, very fragile. And a lot of the discussion at the time was about whether or not the market had moved too fast, too quickly, and whether or not now was the time to take some profits. We also did one of these webcasts in August, and at that point, it was clear that the recovery was starting to get a firmer footing, at least in financial assets. There was a lot of this debate at the time whether or not we would see any form of return to value stocks, which is what we tend to favor. But with economic outlook still pretty weak in terms of growth, it seemed that there was no price too high for structural winners, such as the lofty FANG stocks. We did the last one of these updates back in November, and I think at that point, with vaccine news and the fact that we had a new president in the Oval Office, optimism was really starting to take a hold. And now when we fast forward to February 2021, we see that the risk appetite is even higher than it was when we entered 2020. So in little over a year, we've gone pretty much full circle. Markets are at all-time high. Valuations are rich by any standard other than the dot-com bubble. And we've seen the combination of loose monetary policy and accelerating fiscal stimulus really drive risk appetite upward. And as you can see from the bull and bear indicator, investor sentiment is also back to its highs. So I think, you know, when you look back over the last 12 months, you know, we've had a pretty volatile ride in terms of sentiment, and it's perhaps easy to forget that, you know, we've suffered the biggest economic contraction during peacetime. We had the fastest bear market, i.e. a 20% correction in modern history, and we've also had the greatest V-shaped market recovery that we've seen. So I think as we look into 2021 and the opportunities that we see, it's worth bearing in mind that, you know, things can change pretty quickly, and that the best opportunities don't necessarily always come in the most obvious of times, but also, as we continue to believe, not always in the most obvious of places. So before we go into those specific opportunities, just want to give a quick overview of how the fund performed in 2020. We'll also touch on some of the things that we're watching across the market, but I want to spend most of the time today going through the portfolio and some of the exciting themes and holdings that we have in there. So 2020 was a pretty good year for the fund. We ended also in the Euro share class at an all-time high. The fund returned almost 11% in Euro terms, which was roughly 2 percentage points more than the benchmark that we are measured against. I think it's important to stress that we did that in a market that actually worked against us for most of the year in terms of investment style. As I mentioned in the introduction, we follow a pretty strict value-based investment philosophy, which has been a hallmark of the fund for the almost 20 years since it was launched. And it's been a key differentiator of our returns for good and bad over that time. And in 2020, in isolation, the value factor suffered significant underperformance versus growth stocks. And as you can see on the chart on the right, at almost 25 percentage points difference, the relative drawdown was as big as it was during the peak of the dot-com bubble. And if we look at the year by quarter, it's also pretty clear that it ended differently than it started, both for the fund and for the market as a whole. As we talked through in earlier webcasts, we suffered a pretty significant drawdown in the first quarter, where the fund fell 25%, which was almost 4 percentage points more than the market. We then progressed to regain our footing as the year went by, steadily regaining both absolute and relative performance. And as you can see in the chart on the left, that culminated with more than 20% return in the fourth quarter, which was 7 percentage points ahead of the benchmark. And on the right-hand slide, we show the value and growth returns by quarter. So you can see that our turn up coincided with the rebound in value that we saw in the fourth quarter. And I think that's quite important to bear in mind because it shows the latent potential in the fund should we see a more sustained change in the market backdrop and for the market to return a little bit more in our favor, that we can really perform again. And we think there's a good chance of that. I mentioned that the performance differential was very high by historical standards. So here on the left-hand side, you see the relative trailing 12-month performance of value versus growth, pretty much mirroring or equaling the drawdown that we saw during the dot-com bubble. On the right-hand side, you see that what that has led to is that the valuation discount of the value factor has also expanded materially. So while the average growth stock in emerging markets is trading on 24 times next year's earnings, value stocks on average trade on only 11 times earnings. They haven't really moved since the end of the financial crisis more than 10 years ago, whereas growth stocks have been on a continuous upward re-rating. So what we find ourselves now is that the value discount at 54% is pretty much at an all-time high. And for those who look at price to book, now I recognize that not everyone does in this day and age, but the average growth stock is currently trading on almost 5 times price to book versus just over 1 times price to book for the average value stock. So again, at a 72% discount, we are at all-time high discount levels, and the return differential, the ROE differential between the average growth stock over the average value stock is only 4 percentage points. So you have a 72% discount on valuation for an average 4 percentage point difference in return on equity. If we look at the year in terms of where returns came from by country, South Korea, which is an important market for us, where we entered the year with 23% of the portfolio, was the best market within the EM index. In euro terms, it was up 30%, predominantly driven by expectations of a cyclical recovery, particularly in the memory space, where Korean operators are very, very strong. But also the market offers pretty good exposure to many of the green and sustainability trends that came through in 2020. And I'm thinking in particular about electric vehicles, which we will return to later when we go through the portfolio. Other markets that did well was China. For as many of you will know, it has a large internet economy, And I think importantly, as the country that was first in, it was also first out of the corona pandemic, and therefore saw more of a recovery as the year went on. At the other end of the spectrum, we predominantly find within the large countries in the index that it was commodity dependent, and then in particular oil dependent countries like Russia and Brazil that did the worst, but also some of the more tourist dependent countries like Thailand and Turkey also suffered pretty material drawdowns, particularly on the currency side. What I think is interesting is the year where uncertainty was high, we still saw that emerging markets in euro terms returned more than developed markets at just over 8% for the year. So I think that risk appetite did come through in the second half of the year, and that has benefited the EM asset class. If we drill down another level in terms of our portfolio, I mentioned that we'd had a pretty good tailwind from Korea. In fact, 5 of our top 10 returning companies for 2020 were in Korea. And here you see that within the top 5, LG Electronics and Samsung Electronics were the standout performers for us. But we also had good returns from LG Chem in Korea. Now, both LG Electronics and Samsung Electronics have been pretty strong beneficiaries of working from home trends. And we've also seen that consumers have been more than willing to upgrade their home appliances and consumer electronics as they've spent more time at home. We also had strong contributions from our EV supply chain. On this chart, you can see Ivanhoe Mines, which is our copper project in the Democratic Republic of Congo. That will go into production in the third quarter this year, and obviously we've seen a significant de-risking of that project as it has progressed towards that milestone, but also the recent trend in the copper prices has clearly been beneficial. I mentioned the LG Chem, which I think other than being in the right place at the right time is also doing many of the right things, and we will see that it will spin off its highly priced energy solutions business with the strong exposure to EV batteries during the course of 2021, which should also unlock some of the value there. Finally, I mentioned China, first in, first out in a strong internet economy. We don't have as much direct exposure to that, but Naspers, our South African listed investment company, does have a significant stake in Tencent, the Chinese internet company. So clearly that benefited strongly from that. On the negative side, we have the biggest headwinds from the bank sector, which in addition to sort of suffering from fears over higher bad loans exposure, also came under pressure as interest rates were cut massively across the markets that we look at. We did exit a number of those positions early on in order to limit our losses, and we redeployed that capital elsewhere. We've also exited our positions in Royal Dutch Shell, which came under pressure as it cut its dividend immediately after the pandemic started to bite. If you look at where the capital was deployed, we made a number of refreshes to the portfolio during the course of the year. A lot of them were in the consumer and technology related sectors because we found that the valuations became pretty attractive during the dislocations in the market. But we've also maintained a balanced portfolio, actually re-engaging with the energy sector in Petrobras and Lukoil, as well as adding a couple of companies in the financial sector, both of which should do pretty well if the reopening of the economies continues and we see some form of inflation expectations arising on the horizon. So those have already been pretty good contributors so far. Just in terms of activity levels, we added almost 20 new positions during the course of the year, which is as much as 2018 and 19 combined. And we've continued as the markets have continued to rise recently, we've been recycling some positions in 2021 as well. So despite valuations, I guess on the general basis being high, we have a pretty strong pipeline of still attractive opportunities in front of us. So if we turn to the market backdrop, I mentioned that it was a year of weak economy and strong markets because of the corona pandemic, and I think that you see that now in valuations across the world. Part of it is, of course, that earnings expectations for growth over the next 12 months have come up because you're coming from a low base effect in 2020. But I think it's not possible to really ignore the fact that in a historical perspective, most markets and the US in particular is trading at elevated levels. EM index in dark blue at the bottom there is currently at 16 times 12-month forward earnings. Whilst it is a discount versus developed market, it is higher than the 12 times sort of historical average. On the other end of the spectrum, you've got the Nasdaq, which on over 30 times earnings is roughly 50% premium to the developed market index. So I think again, it's pretty clear how investors in general are positioned and where they are the most bullish. Now we have sentiment is high, valuations are high, and we get a number of questions from clients as sort of what we think about sort of market going forward. Are we due a correction? Are we in a bubble? I think we use the Google AI-powered algorithms to find the simple answer, and I guess the algorithm is certainly entertaining the idea that stock markets may be overvalued at the moment, but what does it mean? I think some of the things that we're looking at, we do see some excess building in the system, particularly in the US, which is of less consequence to us. And what I would highlight is that you see trading in stocks with very, very high valuations has exploded. So the chart on the left in the dark blue line, you can see that almost a quarter of trading in US stocks is in companies where the valuations is higher than 20 times sales. And we're not talking 20 times earnings, we're talking 20 times sales, which certainly in a historical perspective would be considered very, very high valuations indeed. And that to me at least is an indication of speculative activity. Now secondly, the market is becoming narrower. So on the right hand side you see in the blue line at the bottom measures the proportion of stocks in the S&P 500 that is actually beating the index over a rolling 12-month period. And again, you have more and more money chasing fewer and fewer stocks. So actually only about 30% of stocks in the index are beating the market. So the market is becoming narrower and narrower, which are sort of signs that we saw both during the dot-com bubble, but also for those with a penchant for history, what we saw during the Nifty 50 bubble in the 60s and 70s. And I think it's also worth highlighting that it's not just regular money doing this, it's largely on borrowed money or increasingly on borrowed money. On the left-hand side, you see margin debt in the US. So this is money borrowed with the express purpose of buying financial instruments that are trading close to all-time highs. And as a proportion of the US economy, that has now reached an unprecedented high level. So you have more borrowed money than ever, chasing a shrinking number of winning stocks, trading at historically high valuations, and a lot of them are in the same place. The chart on the right shows that, like in any other sort of late stage bull market, IPOs, here measured in green, are very, very hot. You see people chasing IPOs. We see the special purpose acquisition company coming to market. And we also see that there are certain sectors that are, again, attracting a lot of the flows and a lot of the attention. I guess it's interesting to see that the alternative energy space is very attractive following the Biden presidency. But I think importantly, we're seeing in light blue here, non-profitable tech companies have on average returned 4 times since the start of the year, since the start of last year, which again shows a huge increase in the way that people are assessing the future. So is it time to call the top on that? For many, it probably is tempting, but for us, we don't think that is the right way to go about it. There are still large parts of the market that we find overlooked and where we find attractive opportunities that are currently out of favor. Corrections are part of being in the market. We don't necessarily try to avoid them by market timing. We avoid them by preparing for different scenarios that can play out. And I think for us, the most important thing is to look where we find attractive prospective returns based on our assessment of the companies that we are invested in. And we do this through our value-based investment philosophy, which has steered us clear of the market's worst excesses also historically. And I think it's also very important to make a distinction between recent capital gains and also your expectations for long-term value. And to do that, you know, many people use lower interest rates to justify high valuations that they're looking at. And of course, if we use bond as an example, lower discount rates does mean higher prices, all else being equal. If we flip it on its head and say, you know, does the price paid inform future returns? And for a bond, that's pretty easy to calculate. If you have a fixed payout in the future and no credit risk, you can easily calculate the annualized return. So if you're lucky enough to buy $100 paid out in 10 years and pay 10 for it, then you have an annualized return of 26%. And the more you pay, the lower your annualized return becomes. And if you're unfortunate enough to pay $110 today for $100 in 10 years time, you will of course have a negative yielding instrument, although the running yield of it will be not be negative. You're not losing money on a daily basis in terms of holding that instrument, but it will crystallize at one point in the future. So if we use a slightly more relevant example and saying what happens if the bond pays a regular coupon, and here we use an example where you have a bond paying 10% per annum half yearly for 5 years. So basically 2 times a year you get paid $5 on a $100 bond. So this is more like a stable dividend paying stock that we're used to analyzing. So if rates are 10% and you're getting 10% per year, the price will be 100 and you'll make 10% per annum. However, if rates go down and you basically, let's assume that that discount rate goes down to 5% the day after you've bought it. Now, in that case, the price of the bond reflecting the lower interest rate environment would go up by 22%. So you would make an immediate capital return on that investment, and you would no doubt be pretty happy. However, what happens then if you hold it to maturity, your returns will actually be lower than what you thought when you bought it. So that $100 bond, you will get your $100 back, you will have your $50 worth of coupons, but your reinvested coupons will have a lower value than they otherwise would have done because you're reinvesting at 5% instead of 10. So actually your annualized return would be 9%. Now, if you flip it on its head and say if rates were to go up, of course, again, you flip things on its head. So you would take an immediate capital loss if you were marking to market, and you would most likely be pretty unhappy. But again, if you held to maturity and you looked at the total value delivered over that 5-year period, you would actually be reinvesting at a higher rate. So your reinvested coupons would actually be $21 instead of the $6 in a lower rate environment. So depending on your time horizon and how long you're holding it for, the rates have a different impact on your immediate capital returns, but your expected value will move in the other direction. So I think that's quite important when we're assessing how we feel, that timing matters, and when we look around us, because what's key to us is what are the long-term expected returns on a forward-looking basis. So of course we are happy if we recognize an immediate capital gain if someone's willing to pay us a higher price for stock we own than we paid for it yesterday. But we will only buy those stocks if we have the expectation of a reasonable return over that long time horizon. So when we have $15 trillion of negative yielding debt in the world, is it crazy to buy that? And again, it depends on your time horizon. There's no cost of holding it. And in the short term, if rates go down even further, you would most likely recognize a mark-to-market gain and you'd feel happy. But obviously, if you're holding it to maturity, you will recognize that negative return, which is what we're trying to avoid. So what we're seeing is that in the more speculative part of the market, investors are not thinking about the long-term returns that they are locking in or the value that they may be locking in for the long term. They're looking for that short-term capital gain based on other people's behavior, be it chasing tomorrow's IPOs or where the next dollar is headed. And as many of us will know, that works for some time, but it can't work forever. So let's get into the portfolio and how we've set it up in order to deliver on our expectations. So firstly, this is our steering wheel. We continue to run the portfolio. We are unconstrained, active, and value-based. That means at any given time, we put our best ideas in there, regardless of index weight, sector, or geography. You can see on the left-hand side, our active share remains high at close to 90%. And what we see in the middle in terms of our value-based application, the portfolio is trading at a deep discount to the market. Now, interestingly, that discount has widened during the course of the last 12 months as we have been recycling the ideas that where we have recognized the capital gains, we have been able to reinvest that at attractive opportunities again. So we've maintained a pretty stable valuation metric in the portfolio, despite the market becoming increasingly expensive. In terms of exposure and tilt, the portfolio is relatively balanced between large cap, mid cap, and small cap, whereas of course the index composition as it narrows more and more is very much tilted to the large winning stocks of recent years. In terms of the top 12, which accounts for 55% of the portfolio, we feel we have pretty broad exposure to a number of attractive and important themes. We have companies ranging from Korean technology powerhouses. As I mentioned earlier, we have Chinese internet exposure. We have a number of companies exposed to food security and sustainability, and we have real assets in there in terms of metals and mining's exposure, and we are positioned for recovery through some consumer discretionary exposure. And at a near 40% discount to the market in terms of price to earnings, we are continuing to show those value-based characteristics. If you look on the right-hand side, we don't believe that that value is at the expense of quality. So here we've plotted the portfolio, taking the average 3-year return on equity of the portfolio and compared it to various markets. And normally, as you'd expect, there's a pretty clear correlation in the shaded area between the quality as measured by return on equity and the multiple that you pay for that equity base. And the outlier here in terms of higher than average quality versus the EM space at a much lower valuation is Kon-Tiki as the outlier. So in terms of themes that I want to highlight that we're exposed to, for those of you who have listened to us before, you may recall that we built a diversified exposure to the electrification and in particular EV theme during the course of 2018. We did that not through necessarily EV manufacturers, but through the value chain. We built exposure through the miners such as Ivanhoe, Lundin Mining and Turquoise Hill in terms of copper exposure, and we did it through the battery manufacturers such as LG Chem and Samsung SDI, but we also did it through electric vehicle components and some of the better positioned traditional OEMs themselves. Now, with the benefit of hindsight, I think it's clear that the EV theme was a pretty good one to be invested behind, even if we didn't have exposure to Tesla, which of course has been the standout return. And you can see that over the period since December 2018, all of them bar one have posted some pretty significant positive returns. But I think it's worth highlighting that as obvious as it might seem now, it wasn't a movement in a straight line. So if you look at the return composition on a relative basis by year, you can see that both in 2018 and in all of 2019, our electrification basket did not really yield any excess returns, and it all came during the course of 2020. And it just shows, I think, it's more difficult to pinpoint the exact timing than the theme itself. So I just want to highlight one example where we've maintained exposure to the theme. LG Electronics, which you can see on this chart, has been the highest returning stock within that period. I just want to go through in a little bit more detail because it is a company that has delivered high returns, and it would be natural to ask whether or not it's still a deep value play as we believe it is. So just as an introduction, LG Electronics is a global consumer electronics company based in Korea. It's in the top 20 most innovative companies according to the latest BCG report, and it consists of 5 standalone divisions. It has a home appliance and air solutions, so effectively air conditioning division. It has a home entertainment, which is effectively TVs, audio and video, and together those 2 divisions would be considered sort of core consumer electronics. They then have an EV related business, which we highlighted on prior slides, where they make infotainment systems and increasingly EV related components for the OEMs in the auto industry. They also have a B2B business, which is display and energy solutions, predominantly to do with outdoor and large stadium type settings. And the fifth, some of you may remember that they also used to make, or they still do make, mobile phones. You don't see so many of them in Europe anymore, but have a pretty big mobile phone business as well. Now, the interesting thing here is that those 5 divisions all have very different drivers and different stages of their development. The core consumer electronics business is an excellent business, $30 billion worth of sales, earning close to 10% operating margins and 20% returns on capital employed. But as you can see, both the vehicle components and mobile phones make pretty large losses, which has been weighing on the stock historically. So if we look at sort of the breakdown over time, there you can see that despite the losses in vehicle solutions and mobile phones, the 5-year track record of the company is pretty strong, with operating profit almost tripling over the last 5 years. And you can see the quality in the appliance and air solution business coming through as it continues to compound at the levels that its profits are being delivered at. Now, the interesting thing now is that part of the reason why the stock has done well is that we think that there is a real chance that those losses below the line there will be eliminated in the coming years. So firstly, the company has signed a JV agreement with Magna, which is a Canadian supplier to the auto industry with a strong standing within electric vehicles. So the plans there are for a real acceleration in top line growth driven by powertrain solutions for electric vehicles. The second bit, and I think importantly, is that the losses in the mobile division have been large for some time. And what we've seen is that we are getting a more credible plan towards either fixing those or exiting the business altogether. We have had a number of restructurings and outsourcing agreements signed there, and it's clear that management is really approaching this with more determination than previously. So we think that there's a real credible path to eliminating losses that are currently equivalent of 50% of reported profits, which we think would be a real catalyst for the stock. Now, if that's the optionality in the company, if we look at the core, I think we have, a traditional underappreciated quality. Over the last 5 years, here you see the sales proportion coming from the home appliance and air conditioning unit. That shift in sales is important. It's gone from less than 50% of sales to over 65% of core consumer electronics. The reason why that is important is because consumer electronics is lower margins. So if you shift towards home appliances and air conditioning, you're seeing a gradual improvement in the reported margin of those together. And when you do the benchmarking exercise, you see that LG's core now is much more along the lines of leading air conditioning manufacturers in terms of profitability and in terms of returns on invested capital. They are earning now more than 9% operating margins, which is close to the sort of average air conditioning manufacturers, around 10%, and much, much higher than the 6 to 7% sort of regular consumer electronics companies. The reason why that's important is because the market applies much, much higher valuations to air conditioning companies than consumer electronics. The reason for that is that you have a much lower risk of technology obsolescence, and it's less cyclical, and you have a higher potential for value-added services. So you can see here that the average AC company trades on 15 times EV/EBITDA versus around 6 times for regular appliances manufacturers, and LG still at only 5 times EV/EBITDA. So if we value the LG's core operations in line with their proportional profit mix from those two units, we get around 300,000 won per share. If we add in conservative valuations for vehicle solutions and business solutions, we get another 40,000 per share of value. And that compares with the current share price of less than 170,000 won per share. Now we can have a debate about what the discount should be for losses in mobile and whether or not they will close it down. But at 50% of the identified value in the company, we think that's far too great. Now, the interesting thing is that the company also have preference shares, which trade at another 50% discount to the ordinary stock. And this is the one that we own. So effectively, what we're getting is a high quality appliances manufacturer with significant optionality from both corporate restructuring and electric vehicle investment. It's trading on 6 times priced earnings with a 17% free cash flow yield. So we think it's very much possible to be aligned with these strong underlying trends, but not sacrifice our value approach. We have another example, which I will run through quickly, which is also we've recently took a Brazilian pulp producer into the portfolio. Now, for many people, this will be a cyclical exposure. Market pulp is effectively the key ingredient going into paper products such as tissues, toilet paper, and writing paper. The interesting thing about Suzano is that it is the lowest cost producer in the industry, and it is by far the largest player in terms of market pulp. Now, it recently made an acquisition which led to elevated leverage as you came into a down cycle, and that would normally make us pretty cautious on this type of company. But what we've seen now is that the company has ample financial liquidity and no financial covenants. And with a cost savings program in place as well, they are now more profitable at the trough of the cycle than they've been historically. What we have now is that, we can run scenarios as prices are now rebounding from the lows of last year. And we can see that on any kind of reasonable scenarios, be it based on the cost curve or on historical peak or mid-cycle pricing levels, we get a significant earnings upside to the company. Now, at this point, the leverage in the company starts working in our favor, because when we get the excess cash flow generation through from higher prices, we get a deleveraging scenario running out in the company in the tune of 10 to 15% of the equity every year. Now, add on that the higher earnings from these higher prices as well, and you get a pretty significant uplift without having to assume that the stock re-rates in terms of its earnings multiple. Now, we believe that the market should pay a higher multiple even on these higher earnings, because the company goes from being sort of a cyclical, highly levered company and can trade into a multiple more in tune with other sustainability focused forest and pulp and paper companies. Here in green and blue, I've added sort of the Nordic leading peers in terms of sustainability credentials and what the company is exposed to. And we think that there is therefore a strong argument why Suzano should re-rate on these higher earnings as well. And the company has significant sustainability positioning potential in our view. Firstly, it has a negative carbon balance because of the plantations that it runs, and management has set up very clear 2030 environmental goals, which includes plastics and petroleum derivative substitution using their pulp. And importantly for us, in terms of execution, this is now linked directly to variable compensation of its executives. So that was a very, very quick run through of some of the things that we are looking at and are positioning at the moment. I think to sum it up, 2020 was a pretty good year despite the challenging backdrop. We are conscious of elevated investor sentiment and valuations, certainly in certain areas of the market. We've positioned the portfolio to have quality, but at a very significant discount to the overall market. And I think in terms of our idea generation process, which has been working over the last year or so pretty well, we are attaching ourselves to some of the very important themes that we see in the market, but we don't sacrifice our sort of valuation credentials on it. And we do find attractive opportunities within these sectors as well. So thank you very much. I ran over, but we'll hand over to Ole Kristian if there are any questions. Thank you.
Thank you very much indeed, Fredrik. And we do have a few questions, so I hope you'll bear with us for spending a bit more time than scheduled. Okay, and the first question is, are there specific sectors that you find particularly interesting in a value and emerging market context in the wake of the corona crisis? And if yes, which sectors do you find interesting and why?
Well, as a broad market fund, I mean, we find all sectors and countries interesting, but I guess the key for us is that firstly, we are a bottom-up investor. So we are focusing on the individual companies. The risk reward for each of the stocks in the portfolio needs to be in line with our expectations and what we're looking for. It's clear that the corona pandemic threw up a number of new opportunities. And you saw that in our activity levels from last year, that it allowed us to pick up some pretty attractive, I think, exposure to big technology trends like 5G during the course of the year. We bought into a company called Tech Mahindra in India. And I think, again, the sustainability angle that really came to the forefront of investors' minds during the course of the year was also an area where we are still able to find attractive opportunities. And finally, I do need to highlight that, we are also coming out of this pandemic. We see inflation expectations are creeping back up. We do see dislocations in certain commodity prices. The price of oil even is starting to come up. And we do need to be conscious of the fact that, the market backdrop may be different going forward than it has been in recent memory. So we have maintained our exposure to a number of sort of commodity linked sectors as well, and financials also is in there. These are traditional value sectors.
Okay, we have another question. What do you think the catalysts for halting the momentum trading or greater fool strategies that have been driving markets up in favor of value?
If I knew that, I would know when to time my put for. But with all seriousness, it's always very difficult to know what is the trigger for these kind of things. The greater fool theory, of course, suggests that you think there is another fool around the corner. So if there is no greater fool than yourself, there is your trigger. You are the bag holder. But I think what we are trying to do is to make sure that the expectations that we base our investments on are sound and conservative in a historical perspective. The valuation multiples that we pay for those conservative expectations are sensible, both in a historical context, but also what we expect going forward. And that is all that we can do in order to protect the portfolio in the best possible way.